Something just happened in the Bitcoin market that should stop you cold. Not because of the price, not because of the headlines, but because of who did it, when they did it, and more importantly, why it signals something much bigger is coming. While retail investors were panic selling their positions, while fear and greed indicators were flashing extreme fear, while financial media was running wall-to-wall coverage about Bitcoin's next collapse, one man quietly, deliberately, and without a single moment of hesitation deployed nearly $2 billion into Bitcoin. Not a hedge fund following a model, not BlackRock executing a passive strategy, not a sovereign wealth fund following political orders. Michael Saylor. And here's the detail that keeps me up at night. This wasn't emotional. This wasn't impulsive. This wasn't even surprising, if you know how to read the signals. Because when you study Saylor's moves over the past 5 years with cold, analytical eyes, you start to see a pattern that most retail investors never notice. A pattern that has quietly predicted some of the most important turning points in Bitcoin's entire history. But this latest move, this $2 billion statement made during peak fear, feels different from everything that came before it. And I'll tell you exactly why. Stay with me until the final section of this video, because what I'm about to show you in the last few minutes genuinely changes how you'll think about Bitcoin, corporate finance, and long-term wealth strategy permanently. This is the wealth continuum, and this is the breakdown most people won't get to hear because most people stopped watching at the headline. Quick note, nothing in this video is financial advice. I'm breaking down publicly available information and market behavior for educational purposes. Always do your own research and make decisions based on your personal situation. Let's start at the beginning. Because context here is everything. When Saylor made this move, Bitcoin was not in a comfortable place. The market was bleeding steadily. Sentiment had turned decisively negative. Leverage positions were being wiped out across major exchanges. Crypto influencers who had been aggressively bullish were suddenly posting about waiting for lower levels. The headlines were brutal. Recession fears were circulating again. Regulatory uncertainty was back in the conversation. Liquidity stress was making institutional desks nervous, and the general mood in the market was, get out and wait. That's the environment Saylor walked into. And instead of waiting, he pulled the trigger on one of the largest single Bitcoin acquisitions strategy has made in recent memory. Nearly $2 billion. During the fear, during the uncertainty. During the exact moment when the crowd was most convinced that lower prices were coming. Now I know what some of you are thinking. He's always bullish. He always buys. That's just what Saylor does. And I understand why you'd think that, but that's actually an oversimplification. And getting it wrong means missing the real strategy underneath. Because Saylor doesn't just buy. He buys with timing precision tied to specific psychological market conditions. He buys when volatility spikes to uncomfortable levels, headlines turn maximally negative, weak-handed investors get emotionally exhausted and sell, and the narrative around Bitcoin feels like it's about to permanently break. That's the signal he's been waiting for every single time. And here's what makes this psychologically interesting. Most investors are wired to feel safest when prices are rising, and everyone around them is excited. They feel most afraid when prices are falling and everyone is panicking. Saylor has spent years training himself and his entire company to operate with the exact opposite emotional framework. Fear is not a warning to him. Fear is a discount signal. And that mental inversion is the core of everything strategy has built. Now, here's the part most financial commentary completely skips over, and it might be the most important piece of this entire video. Morning, afternoon, or night for you right now? Drop it in the comments. I'm curious where in the world people are watching this. This is where most people get Saylor completely wrong. They assume his strategy is about trading Bitcoin, buying low, selling high eventually, capturing the gain. That is not what he's doing. Not even close. Saylor's strategy is ideological at its foundation and institutional in its execution. He believes, and has stated this publicly in dozens of interviews, that the global monetary system is structurally broken. He believes fiat currency is being debased at a rate that slowly, invisibly transfers wealth away from anyone who holds cash long term. He compares holding dollars to holding melting ice. Every year you wait, you lose purchasing power. Every year the money supply expands. Your savings represent a smaller slice of real economic value. And his solution, his answer to that problem, is Bitcoin. Not as a trade, not as a bet, as a monetary escape route. That's why his buying behavior looks irrational to traditional investors. Because traditional investment frameworks are built around quarterly performance targets, short-term risk management, downside protection strategies, correlation with the broader market. Saylor threw that playbook out the window. His framework is built around one central question: what will preserve and grow real value over the next 20 to 30 years as monetary systems continue to evolve? His answer is Bitcoin. And once you truly understand that framework, his panic buying doesn't just make sense. It becomes logically inevitable, because inside his model, every dip is just a discounted entry into the asset he already believes will win long term. But here's what's genuinely fascinating, and what's changed recently, because Saylor's messaging has evolved in a very specific direction. And when you pay close attention to that evolution, you start to see what he's actually preparing for. In the early years, Saylor was almost maximalist in tone. Never sell your Bitcoin. Bitcoin is the apex property of the human race. Bitcoin will absorb all the world's wealth eventually. It was bold. It was inspirational. It was incredibly effective at building a retail following. But in recent interviews and public statements, you can detect a subtle but significant shift. He's become more corporate in his language, more strategic in his framing, more focused on institutional infrastructure. He's talking about capital structure management, about debt refinancing windows, about treasury flexibility, about long-term institutional positioning. That's not the language of a Bitcoin evangelist. That's the language of someone building a permanent financial institution around a single asset class. And that distinction matters enormously, because it tells you that Saylor isn't just betting on Bitcoin. He's engineering a position that he believes can survive multiple market cycles, multiple macro environments, and multiple political challenges. Now, here's the part nobody's paying attention to. Pull up a chart of every major Saylor purchase over the past 5 years. Lay it against Bitcoin's price history, and you'll see something that looks almost too clean to be real. The biggest buys cluster specifically around moments of extreme market fear. The 2021 mid-cycle corrections. The 2022 complete collapse, when the entire crypto industry was imploding around him. The ETF uncertainty periods in 2023 and 2024. The banking panic windows. The global liquidity scares. Again and again and again, Saylor leaned in when nearly everyone else was pulling out. Now, and this is critically important, I'm not saying he bought every exact bottom perfectly. He didn't. That framing would be misleading, and I won't do that to you. Some buys were timed at levels that went lower before recovering. Some purchases sat underwater for months before turning profitable. What Saylor actually did, and this is far more sophisticated than perfect bottom picking, is scale his conviction during fear cycles. He didn't try to find the lowest possible entry. He identified windows where risk-reward was dramatically skewed in his favor. And then he committed capital at scale. That's a completely different strategy. And it's the strategy that has, at least so far, produced extraordinary results. Because here's the math that matters. Strategy, formerly known as MicroStrategy, began accumulating Bitcoin in August of 2020 when the price was around $11,000 per coin. As of May 2026, Bitcoin is trading at levels that have made those early purchases some of the most profitable institutional trades in modern financial history. Not every purchase is sitting on those gains, but the directional bet, the core ideology, has been validated repeatedly over nearly 6 years. And that's why this latest $2 billion move carries so much psychological weight in the market. Because when the single most visible Bitcoin accumulator on Earth responds to a market panic by increasing his position, it forces every other institutional player to stop and ask the same uncomfortable question. What does he know that we're currently ignoring? That question alone shifts market psychology, and Saylor understands that better than almost anyone. Hit, like if this is starting to make sense? Because what comes next is where the real story gets complicated. Now I need to be real with you, because this channel is about building real, intelligent wealth. And that means we don't hide from uncomfortable truths. Saylor's strategy carries genuine, serious risk, and the people who dismiss that risk entirely are making the same emotional mistake as the people who panic sold during the fear. They're letting conviction replace analysis. Here's the core structural concern that Wall Street has raised, repeatedly and consistently. Strategy has used debt instruments, convertible notes, preferred stock offerings, equity raises, to fund significant portions of its Bitcoin purchases. That means the company has obligations, interest payments, maturity windows, capital structure pressures. Now Saylor has repeatedly argued, and the data currently supports him, that the company is structured to survive extended volatility. He's emphasized long-term financing timelines, diverse capital instruments, and flexibility built into the debt architecture. And so far, through every crash, every fear cycle, every moment the critics predicted collapse, strategy has survived. But here's the honest question you should be sitting with. What happens if Bitcoin enters a multi-year bear market that doesn't follow historical cycle patterns? What if the next downturn is deeper? What if it lasts longer? What if the macro environment produces conditions none of the previous models anticipated? Because Bitcoin's previous cycles, the ones Saylor has navigated successfully, occurred in specific macro conditions. Low interest rate environments, expanding global liquidity, retail-driven speculation cycles. We are now in a world that looks meaningfully different. Interest rates have restructured globally. Institutional ownership has fundamentally changed the asset's behavior. Regulatory frameworks are actively forming in real time. Sovereign adoption is beginning, but also creating new unpredictability. And the question that nobody can answer honestly right now is, do those conditions make Bitcoin more resilient to downturns or more complex to predict? Saylor himself has acknowledged, in his more recent, more nuanced public appearances, that scenario planning is now a real part of how he thinks about the company. He talks about capital structure optionality. He talks about debt management windows. He talks about treasury flexibility. That language would have been almost unthinkable from the early, never sell, always accumulate version of Saylor. And I think that evolution is telling us something important. Not that he's losing faith in Bitcoin, but that he understands, finally, explicitly, that even the strongest ideological strategy must survive long enough to be proven right. Because conviction that ends in liquidation isn't conviction. It's a cautionary tale. What happens next in the corporate world is the real story nobody is covering properly, and it starts with a myth that needed to be broken. For years, Saylor was positioned, by himself and by his supporters, as the ultimate Bitcoin maximalist, the man who would hold through everything, the diamond hands legend, the human who turned corporate treasury management into a religion. And that image was powerful. It inspired hundreds of thousands of retail investors. It created enormous brand recognition for strategy. It made every Saylor appearance into a cultural event. But recently, something cracked in that mythology. In recent interviews, Saylor acknowledged, carefully, quietly, but unmistakably, that under certain circumstances, companies operating in the real world need strategic flexibility. He didn't announce a sell plan. He didn't signal a directional change, but he introduced a word into his framework that he used to avoid completely: adaptability. And the Bitcoin community had a complicated reaction. Some saw it as a betrayal of the maximalist narrative. Some saw it as intellectual maturity finally catching up to ideological passion. I see it as something else entirely. I see it as Saylor positioning strategy for the next stage of its evolution as a genuine, permanent, institutionally respected financial entity. Because here's the thing about the never sell narrative. It's a powerful retail marketing message, but it's a dangerous corporate operating principle. Real institutions, the ones that manage trillions, the ones that have survived multiple decades, don't operate on ideology alone. They manage risk. They maintain flexibility. They adapt to conditions they didn't anticipate. And the fact that Saylor is now speaking more like an institutional architect than a Bitcoin preacher, that might actually be the most bullish sign of all. Because it means strategy is no longer just a bet on Bitcoin's price. It's becoming a permanent feature of the institutional financial landscape, and that changes the risk profile in ways most retail investors haven't fully processed yet. Comment below if you're starting to see Saylor differently after this breakdown. I want to know how your thinking is shifting. Here's where I want you to think differently for a moment. Forget price targets, forget short-term volatility, forget what Bitcoin does in the next 30 days. Think about the decision-making process inside corporate boardrooms right now. You're a CFO at a mid-sized public company. Your cash reserves are sitting in treasury instruments earning modest returns. But you've watched inflation erode real purchasing power steadily over the past 4 years. You've watched Bitcoin survive every major crash it's encountered since its creation. You've watched Saylor's company, once mocked, once dismissed, once considered reckless, post some of the most dramatic balance sheet transformations in public company history. And now you see him buying $2 billion during a market panic, not hesitating, not hedging, not waiting for clarity, just buying. What happens psychologically in that boardroom? Suddenly, Bitcoin doesn't look like a speculative experiment. It starts looking like a strategic reserve decision. And that reframing, from speculative asset to strategic reserve, is the single most important narrative shift in Bitcoin's entire history. Because once that framing takes hold inside enough corporate boardrooms, the game theory kicks in. One company allocates Bitcoin, their competitors watch. If Bitcoin appreciates, the early mover gains a treasury advantage. Competitors can't afford to be permanently behind on balance sheet performance, so they begin evaluating, then allocating, then competing. That chain reaction, once it starts, creates its own momentum. And Saylor hasn't just predicted this dynamic, he has engineered it. Every public appearance is a masterclass in corporate incentive theory. He's not just talking to retail investors. He's talking to every CFO, every board, every treasury committee, every sovereign wealth manager who might be in the audience. And he's making the same argument relentlessly with increasing sophistication. You cannot afford to be the last institution to understand what Bitcoin represents. Now here's the uncomfortable question worth sitting with. Are you positioned to benefit if that argument continues to gain institutional traction? Or are you watching from the sidelines, waiting for the moment when there's no more uncertainty, which is also the moment when the asymmetric opportunity disappears? Because history is very consistent on one thing. The biggest wealth transfers don't happen during moments of obvious clarity. They happen during moments that look, from the outside, like complete chaos. Subscribe now if you want to stay ahead of what's actually developing, because the next phase of this story is going to move fast. Let me bring everything together now, because I want to be precise about what this latest purchase actually communicates, beyond the obvious. On the surface level, yes, Saylor bought Bitcoin during a panic. He's done it before. It's consistent with his strategy. That's the headline version. But underneath that headline are three signals that I think deserve serious attention. Signal 1, scale as communication. $2 billion is not just a number. At that scale, a purchase becomes a statement. It says, we ran the analysis, we examined the risk, we stress tested the balance sheet, and we concluded that deploying at this moment was the right move. That level of conviction, expressed at that level of capital, lands differently in institutional circles than any tweet or interview ever could. Signal 2, the timing architecture. Strategy doesn't execute $2 billion trades casually. The capital markets mechanics behind a purchase that size involve weeks of planning, regulatory compliance, investor relations coordination, and board-level approval. Which means this decision wasn't reactive. It was premeditated. Saylor didn't wake up one morning during a panic and decide to spend $2 billion. He had already decided. He had already structured the financing. He was waiting for the panic. And that premeditation reveals the sophistication of the strategy at a level most commentary completely misses. Signal 3. The institutional message being sent right now. Every major financial institution in the world is watching Strategy's balance sheet. They're watching how the debt is being managed. They're watching how Bitcoin's price movements affect the company's financials. They're using Strategy as a real-world test case for Bitcoin as a corporate treasury asset. And every time Saylor buys during fear, and every time Bitcoin subsequently recovers, it adds another data point to that institutional test case. It builds the argument that aggressive accumulation during volatility works. And if that argument continues to be validated by market outcomes over the next several years, the institutional wave that follows could be unlike anything Bitcoin has experienced. Not retail FOMO, not speculative mania. Systematic, board-approved, treasury-level allocation from companies that currently hold trillions in cash and short-term instruments. Do you think that wave is coming? Or do you think this cycle ends differently? Tell me in the comments. I rate every response. I want to close the analysis honestly, because this channel doesn't do hype without accountability. There are real risks embedded in what Saylor is building, and you deserve to understand them clearly. Risk 1, the macro environment. Saylor has never faced. Every successful Bitcoin cycle Saylor has navigated occurred during a period where global liquidity was generally expanding. Low rates, money printing, risk appetite. That environment may be structurally different now. Central banks globally have restructured their approach. Fiscal pressures are real across major economies. Liquidity conditions are more complex and less predictable than they've been in the past decade. If Bitcoin's next bear cycle occurs within that different macro context, and the cycle is deeper or longer than previous ones, Strategy's debt structure faces pressure it hasn't been stress tested against in the real world. Not necessarily catastrophic pressure, but real pressure. And pressure creates forced decisions. Risk 2, concentration creates fragility. The deeper Strategy's identity becomes tied to Bitcoin's price. The less operational flexibility the company has to navigate unexpected challenges. They're not running a diversified business that happens to hold Bitcoin. They've become a Bitcoin holding company with a nominal software operation attached. That's either a visionary play or an extraordinary concentration risk, depending on what Bitcoin does over the next decade. Risk 3, what happens when imitation becomes competition? If the corporate Bitcoin wave Saylor is betting on actually materializes, the competitive landscape for corporate Bitcoin accumulation changes fundamentally. The first mover advantage that Strategy currently enjoys becomes diluted. And if companies with far larger balance sheets and lower cost structures begin accumulating aggressively, Strategy's differentiation story becomes harder to tell. None of these risks are reasons to dismiss what Saylor is building, but they are reasons to think carefully, with clear eyes and honest analysis, before treating any single strategy as inevitable. The world has a way of humbling certainty, even brilliant certainty. So here's where I leave you tonight. This $2 billion purchase was not just a trade. It was a calculated institutional statement made at a specific moment in time, designed to communicate something very deliberate to a very specific audience. And whether Saylor is ultimately proven right or wrong by history, the behavior itself teaches you something genuinely valuable about how serious long-term wealth strategies actually operate. They don't wait for comfort. They don't wait for consensus. They don't wait for the moment when everyone agrees, because by the time everyone agrees, the opportunity has already been priced in. They identify a long-term thesis. They size it correctly for survival. They endure the volatility. And they keep adding when fear creates discounts. That's not a Bitcoin strategy. That's a wealth-building strategy. And it applies to every asset class, every market cycle, and every period of economic transformation in human history. The investors who built generational wealth during the Industrial Revolution didn't wait for certainty. The investors who positioned correctly during the Digital Revolution didn't wait for consensus. They acted on asymmetric conviction, while the crowd was still confused. The question you need to sit with tonight isn't, is Saylor right about Bitcoin? The question is, do you have a thesis about where real value is being created right now? And are you positioned around it with the patience to survive the volatility? Because if you don't, you're not investing, you're spectating. And spectating during a historic wealth transfer is the most expensive mistake you can make. Share this video with someone who's sitting on the sidelines right now, someone who needs to understand what's actually happening in these markets before it's too late. They don't have to agree with Saylor, but they should understand the game being played. If this breakdown made you think differently about anything, the market, the strategy, the psychology of long-term wealth, subscribe to the Wealth Continuum right now. Because we're entering a period in global finance where the decisions you make in the next 12 to 24 months could define your financial position for the next decade. Not because of one stock, not because of one asset, but because of how clearly you understand the forces reshaping where real wealth is being built and transferred. That's what this channel is about. Not hype, not predictions, not promises. Clear thinking, real analysis, and the frameworks that actually matter when the noise gets overwhelming. Are you positioned or just watching? That's the only question that matters right now. Drop your honest answer below. See you in the next.